Welcome back in. Recent numbers show the U.S. economy is doing better than expected, but how many of you are actually feeling better about your finances? And for those of you hoping mortgage rates drop, what is the likelihood that happens this year? Joining us to offer some insight and analysis is longtime chief economist John Norris, now with Oakworth Capital Bank. John, thanks for coming in. We do appreciate it.
Thanks for having me, Mike. I appreciate it.
Yeah, thank you. So, you've previously have said gross domestic product, GDP numbers.
That's right.
It's really a big indicator on how the economy is doing. So, in layman's terms, explain what that is and why it's significant, that the numbers were better than expected.
Without a doubt. Gross domestic product is really just how the government calculates exactly how economic activity is doing. It's a very simple equation. C plus I plus G plus or minus net exports, consumer expenditures, private fixed investment, government expenditures, and then whether or not our trade deficit improves or gets worse. And so the reason why that's important is just kind of adding everything up, letting us know how we're doing. And yeah, you're right. This past Friday, the government announced that the economy, or GDP, grew at a 3.3% annualized clip during the fourth quarter of last year. That caught everyone by surprise.
And then you look at the inflation numbers, and there are differing opinions on this. So I know what the data says, but people's real life experiences aren't that. Why is there such a discrepancy in what the numbers say and then what people are actually paying for stuff?
Well, when the government and people that do what I do for a living say inflation's coming down, they're talking about the rate of price increases, whether or not increases are coming down, not whether or not prices are coming down. So when I sit there and say, hey, Mike, inflation's 3%, but it's coming down, you're going, hey, great, I'm going to go to the Publix and all of a sudden my mayonnaise is going to be 3% less. That's not the way it works at all. Prices generally go up on the elevator and come down using the steps, and that's what we're seeing right now. So people are getting the message, inflation's coming down. What they're hearing are prices.
So it's really the rate of inflation that's
right.
come down, but it's just not come down to levels that they were.
Right.
And the Fed's waiting for it to get down to 2.5%, maybe even 2% before they start cutting rates. When do you think they could start cutting rates?
Well, according to the futures market, the Chicago Mercantile Exchange, where you can trade just about anything, Mike, right now they're saying probably mid-May is when the Fed starts cutting the overnight lending target for the first time. And right now there are people out there thinking that the Fed could cut the overnight rate 5 to 6 times by 1/4 of a percentage point each time this year. We're telling our clients, we're telling our prospects, we're telling everyone that will listen, 6 times might be a lot. We're telling people to maybe plan for 3 to 4.
Okay, more of a realistic picture there. And I know a lot of people are on the fence there whether to refinance or try to get a home. So
that's right.
Maybe there's some good news down the road for you. All right, what about people's retirement accounts? The markets are doing really well.
Yeah.
Everybody's expecting at some point a headwinds. What about the headwinds? Do you see some?
Well, there are headwinds. As a matter of fact, we had the headwinds last year, and they really didn't even seem to matter or anything. I mean, the markets were up very significantly. S&P 500 up 22%, NASDAQ up 35%. If you took a look at your year-end statement, your 401k plan, you're probably very pleasantly surprised. All those headwinds are still there. However, if we can get the Fed to just kind of participate, lower the overnight rate, lower interest rates, lower the cost of money in the U.S. economy, we should be able to have a decent year in the markets this year. Yeah. We're telling our clients to expect anywhere from 8 to 10%, maybe for the broader market. If you invest correctly, you might be able to squeak out low double digits, but all told, that 60-40 portfolio, that's 60% equities, 40% fixed income and cash, you should be able to have a 6 to 7% type rate of return this year.
All right, we hope that helps a lot of you folks out there. John Norris, we always do appreciate it. Thank you so much.
Thank you, Mike.
All right, we'll be right back.